Hi, my name is Roy Rumbo, and I'm an accounting professor at the University of North Texas. I am doing this lecture about deferred taxes and income tax accounting, primarily for my intermediate accounting 2 students. Obviously, it's available on YouTube publicly, and I certainly want to give credit to the publisher, McGraw-Hill. I'm using their textbook. It's the Spiceland Nelson Thomas Intermediate Accounting Textbook. Love the book and highly recommend that book to everyone. And with that, we're going to get started here. I will just note that the accounting for income taxes can be a mind twister. I'm not going to say it's difficult. Once you figure it out, it's easy. Do not be intimidated by it. I'm going to do everything in my power here to simplify it. I think that's difficult in one shot, so I think this will help you get started. And I think you're gonna have to spend some time with your textbook to totally immerse yourself and do some of the accounting problems to understand it. So with that, I'm gonna share my screen and get started. And before I start, I want to do one thing here. I gotta get rid of this meeting controls. And I know this is recording. So I'm just going to talk, the issue here that we're going to see, and I'm getting into all the slides, is we have a set of rules for financial reporting to calculate net income, or let's say income before taxes. We have rules all the way for tax accounting, all the way to net income, which we're going to be looking at here. But the rules for what is a revenue in this accounting period, whatever accounting period, let's assume full years, because income taxes are reported on an annual basis. And so our accounting rules for what is a revenue and what is an expense are established by the FASB. And they're a very clear set of rules, and they try to reflect the underlying economics of all the transactions that happen in that fiscal year. Well, the income tax return is based on rules established by Congress and administered by the Internal Revenue Service. And guess what? They're very, very different than our rules for financial reporting. Why is that? Because, I look at it personally, and you can look at the textbook for their answer, but I have two opinions on that. One, they are trying to motivate behavior. So they're going to allow companies greater latitude in depreciating things early to motivate companies to go invest in long-term assets. So that's one thing that you'll see when the tax return. We'll see accelerated depreciation. Things will depreciate, much faster, while we may on the tax return versus on the books. Now, when I say books, I want to clarify that. That means the financial reporting, the financial statements, everything we're studying in this course. So we commonly refer to that as the books, and the tax return as the tax side. So, depreciation may be what we call accelerated, and we may depreciate some assets, far faster in the earlier years for tax purposes, while we're still doing just straight line accounting for book purposes, and the expenses spread evenly over the life of asset. Where in the tax return, we may have higher amounts of tax in the earlier years. So that's part of my first thought, in that the tax authorities and the Congress are trying to motivate behavior. Second point is the IRS and Congress as well are trying to mitigate fraud, people reporting more expenses than they should on their tax return, so they pay less taxes. So therefore, some items we're going to expense on the financial reporting side, on the book side, based on estimates of future cost, because we want to match the expenses with the revenues for the financial statements. The tax return, they're not worried about that. Not trying to match revenues, expenses, and prepare financial statements. They're trying to collect taxes. So for some of these items, like warranty expense, they're only going to allow companies to count that warranty expense as an expense when you pay a claim. So they're going to be much more cash basis, and that helps eliminate fraud, because if you allow people just to estimate future claims, for tax purposes, they're going to estimate really, really high amounts of future claims and pay less taxes now because they're going to be motivated to do that. So that's my second opinion, that some of the differences relate, and you'll see more cash basis accounting on the tax side for certain items because they're trying to mitigate fraud, or make sure, hey, kind of show me that this is really an expense. We'll count it as expense when you pay for it. And so before I get right into the slides, I'm going to show you two scenarios that in the books go through this the slides go through this relatively quickly, and it worries me as I walk through it, because I will walk through it pretty fast as well, that you might not see exactly what's happening. So I'm going to, again, just kind of preset this so you understand. And the two examples I'm going to look at, number one is an installment sale. And the second one is going to be warranty expense, which I mentioned earlier. So in an installment sale, let's say company sells a product for $300,000. And they accept an installment note with three $100,000 payments. Now, for the interest of simplicity, I'm going to ignore the time value of money, because you know that we would discount these three $100,000 payments using the appropriate market interest rate, and we would not record a full $300,000. So bear with me, because I know you know better than this, but I'm going to ignore the time value money just to keep this simple. So what would, on the book side, what we do with this? We're going to record, and I'm going to ignore the cost of goods sold too, because that's another area. I'm just going to look at the revenue side here, and that's where the difference is between tax and books. So on the book side, we're going to debit notes receivable for $300,000, and we're going to credit revenues for $300,000. So note, on the book side, in the year we do this, we record a $300,000 profit. Guess what? On the tax side, we do not record a profit for this. Again, here's one that the tax authorities are more cash basis. We will record a profit, and so this is good for the taxpayer, by the way, only when each of the payments are made. And so I think it makes it easier for the tax authorities to audit and verify things that are done based on the actual payment versus any kind of estimates. And that would be probably hard for the IRS to get in and evaluate all these different estimates of the future and the discount rates and everything else. So let's just try to look at this. I'm going to call this year 0, and then year 1, year 2, year 3, and let's assume that, and then I'm going to look at the total of all these. So revenues for the books. Well, we're going to record right immediately $300,000. And in the future years, we're not going to record that. And so we end up with a total of $300,000. Revenues for the tax return. Sometimes I'll just say taxes. You just assume that means a tax return. The tax return doesn't record this amount. It records 100,000 of revenues in the future years. Still ends up with a total of 300,000. Now, I want to note one thing here that you're going to see in these slides. The total is the same, both for books and for taxes. It's a timing issue. And what we like to say is it reverses. You know, this difference, we got a $300,000 difference, and it reverses in the future. This is what we call a temporary difference. It's a temporary difference because eventually it will all wash out. Now, let's look at tax expense. Cash basis. Are we allowed to do tax basis in generally accepted accounting principles? No, but let's just look at it. If we said, hey, let's just do taxes on a cash basis, and let's say 30% tax rate. So we would have $30,000 of, tax expense, total of $90,000. And again, 30% rate. So here was the income in year one, year two. This is what was on the tax return, and we're gonna have tax expense of $30,000. And let's say profit on the books, we'd have 300,000 here in year one, but then we would have a minus 30,000 in the future. We still end up at 210,000. Now, do you guys see a problem with this? And really, I hope you see a problem with this, because we've got expenses in the future that where nothing happened in the future. And we have a 300,000 profit in this, whenever this transaction took place, with no tax expense. Okay, that is not accrual accounting. So what we've got to do is find a way to move this 90,000 over here to this year. Now, I hope you see at this year, and you got to pay $90,000 of taxes in the future. Does that sound like a liability? Yeah, that's the definition of a liability. Go back to chapter 13 lectures. So, now there's going to be some ways we get here on this. There's some shortcuts to come up with this answer, but I'm going to give you kind of a simple look at this, how this works. We're going, in this year right here, we're going to ultimately create this journal entry. Debit income tax expense for 90,000. Credit what we call a deferred tax liability of 90,000. And so, hey, here's your first kind of term right here. And that's what's called a deferred tax liability. Means we're going to have future taxable amounts that are related to things in this year. Now, I mentioned there's going to be shortcuts. Why do we need shortcuts? Is because companies doing this, they don't just have one transaction. They might have a million transactions like this, and they might be in different years and things going on. So we got to find a kind of a secret kind of path to get there. Well, there's a secret path. I could look at my balance sheet, and I know that I've got a note receivable of 300,000. And I know that that we got a tax difference here, because that note we've already recorded, because it's in the receivable, we've recorded some revenues for that have not been reported on the tax return. That's just why, because it's sitting on the balance sheet. I can just take that number times my tax rate, and I have my DTL. By the way, I'm going to be using this abbreviation a lot, DTL, Deferred Tax Liability. And we're going to see a Deferred Tax Asset, and I'm going to use DTA. You know, we use this kind of frequently when we do income tax. So I could just look at the notes receivable balance. And let's say we had, like I said, thousands of these, and the notes receivable balance, some partially, let's say it was 15 million. And maybe there's some that are partially paid, so they're not, but I know that amount, we're going to have future taxable amounts for that amount. I can just take that times 30%, and I would have that is what my deferred tax liability should be at the end of an accounting period. I don't want to confuse you too bad. I've gone pretty far just with this overview, and that might be scary, but I just want to, at least, if we're going to go through the slides step by step, but I at least want to make sure you understand these differences. I'm going to talk about one more, and this is almost the same numbers as the ones that are used in the textbook, but again, just going to really try to set the stage. And even if this is redundant, I think it's okay, because you need to understand this. So let's assume company A sells $600,000 worth, I'll be real formal here, worth of stuff. They're selling stuff, whatever it is. And they know warranty experience dictates 5% of sales equal warranty cost. So this from chapter 13. What's our entry? We're going to debit warranty expense for 5% of 600,000. That's 30,000. And we're going to credit a warranty liability. Now, on this first day, have there been any claims yet? No. And so, but we've recorded the expense. Well, that's from the book side. And the tax side, no, they don't accept that as an expense. They only, remember, they're only going to do when we have claims. So the next entry we would do is debit, and I hope you remember these from chapter 13, debit the warranty liability. Let's say we have $15,000 of claims in the next year, and we're going to credit cash when we go handle that warranty claim. Well, in that next year, we will get a tax deduction for that $15,000, but we do not get a tax deduction for that $30,000. Again, for simplicity purposes, I'm going to say year one, we had no claims. Year two, then year three, and I'll put a total out there again. All the claims came through for this 30,000 in years 2 and 3. Again, for simplicity purposes. So expense for books, 30,000 in year 1, because we recorded this entry, debit warranty expense. Expense for taxes, meaning on the income tax return. Year one, zero. They don't accept it. You know, they you don't, I guess they just don't trust us. And then, you know, probably they're pretty smart not to trust it. This would be real cash. You know, let's just say tax rate is 30%. We'll look at that in a minute. But year two, all the claims come through in year 2 and 3. So in years 2 and 3, we're going to be debiting the warranty liability and crediting cash in both years on the book side. On the tax return, these will show up as reductions of taxable income as expense on the tax return. It will reduce the amount of taxes we'll have to pay because it's reducing the taxable income if we have zero here. And so for these items, again, just like my deferred tax liability example, you know, the total is going to be the same. It's just timing. This 30,000 is how we like to say it. It gets reversed on the tax return, and the difference this year is the difference is 30,000. Then minus 15 minus 15. The difference gets reversed in the future. It's what we call a temporary difference. Then what's tax expense? Again, I'll do this like I did last time, cash basis. Zero there. Now I'm going to put a negative number, minus 35% is 4,500. Minus 9,000. Again, we have, and that's you know, we're going to save because $4,500. So we take all of our income, whatever that is, and it's going to tax it at 30%. But then we get to deduct 15,000 from that, and so the tax expense is really a negative. This is a credit to tax expense, reduction in tax expense of 4,500 because these are expenses, not income. And so we look at our income on the cash basis. This is minus 30,000. This is a negative, and this is a plus 4,500 plus 4,500 from an income side, because and then the total is going to be 21,000. This is on the books. Again, if we were cash basis, again, we've got a problem here because we've got future savings, not expenses, savings on taxes related to $30,000 of warranty expense on our books this year. That's wrong. We got to take these and pull them in here so that we have a $9,000 savings year and only $21,000 of expense. So how do we do that? We are going to debit a deferred tax asset for $9,000, and we're going to credit a income tax. Now keep in mind, a credit to an expense is a reduction in the expense. And so let's look at this deferred tax asset. I kind of like to think of it as a prepaid because, you know, here we're going to be paying more taxes here because we didn't get, you know, on the income tax return, this doesn't happen. That doesn't happen in the future. So we're going to have, you know, pay that $9,000 in taxes now, but we'll save it later. All temporary. And so I've got tax deductible amounts in the future. That's that asset that relates to things I'm going to be able to deduct on the tax return in the future. But I bring them forward to match up with the expenses on our book side. This is nothing more than accrual-based accounting. By the way, just like I said on the installment loan, I got a little shortcut because there's a lot of moving. Because in reality, what will be hard about this, let me go back to this right here. What will be hard about this, guess what? In year 2, we're going to have some more warranty expenses and more warranty expense. It gets all jumbled up between the years. And so I need to find a shortcut way to get there. And our shortcut way to get there is what we call the balance sheet method. At any point in time, I've got a warranty liability. Let's say it's 100,000 warranty liability on this on my books. What does that represent? That warranty liability represents all these entries. I've been booking warranty expense for future claims, but they haven't been paid yet. So in that warranty liability of 100,000, that represents all the expenses I booked, less the claims that have been paid. Keep in mind, when claims have been paid, I've got tax deductions. So this represents amounts of claims in the future that I have not got tax deductions for, but yet I've expensed on my financial reporting side. So I can just take tax rate 30%, and my deferred tax asset needs to be 30,000. And so I will adjust my deferred tax assets and my deferred tax liabilities to the right balance. You can see this in the slides. And then the income tax expense is going to be plugged based on the tax return plus or minus these changes. So that, my friends, that's about as good as I can do from an overview of this subject. And the reason I felt a need to do this is because you might not understand just from these quick slides, you know, how these things work on the tax return and how you might have forgot, although you should know how they work on the book side. So with that, again, some of this now will be redundant from some of my overview there, but I want to set the stage for this topic, which can be complex, especially at the speed I normally move through on the slides. So again, for this chapter, and I say this a lot of times, but especially for this chapter, the textbook is your friend. And you got to follow these through so you get the underlying concepts down. And then in the next lecture after this one, 16B, I'll work problems, and hopefully I would try to, if I was you, get the concepts down first and then watch the problems on the lecture, and then hopefully that will just, and you work the problems yourself, and then you'll get this. And once you get it, like riding the bicycle, I don't think you'll forget it, and you can do well on any exam, and you'll know how to do this when you get in real work, because everybody has to do deferred tax assets and liabilities. It's GAAP. So as I said, the revenues and expenses on the tax return are going to differ from the income statement for various and sundry items. And the objectives of financial reporting are different. We're trying to reflect the what happened in the business, but on the tax return, there's it's a lot more political, and they're trying to influence the behavior of taxpayers. And again, the conceptual underpinning here is we're going to look at temporary differences. And that everything only, let me say this, only the temporary differences will result in a deferred tax asset or deferred tax liability. There's going to be some things that are permanent differences. They never reverse. It's either income on the tax return and it's never on the books, or vice versa. Those are called permanent differences. Permanent differences do not result in DTAs or DTLs. Okay, so again, temporary differences about timing, that pre-tax accounting income and taxable income are recognized in different periods, and we've got to move them into the period that we're accounting for. Now, the difference is that, we'll have something called the tax basis of an asset or liability. We can get in that. So differences that originate in one period reverse or turn around in a future period, like that $30,000 warranty expense that originated in year one, but it reversed, that difference reversed when that $30,000 appeared on the tax return in years 2 and years 3 in our example. We're going to look at installment sales, and that's our first example here in the slides. And I showed you that installment sale for financial reporting, we record that profit from that sale in the year of the sale. For tax purposes, it's only recorded when the cash is received. And so therefore, it originates in that first year. The difference originates in the first year when there is an installment sale and the books record that, but the tax return doesn't, but it reverses, 100% reverses in the future years when the installments are collected and the income is reported in the tax return. About timing, temporary differences about timing. So a deferred tax liability, if the tax law allows the company to avoid a current tax payment by postponing it to the future, that would be a deferred tax liability. So let's look at the installment sale that we looked at ahead of this lecture. We recorded on the book side, if you remember, the $300,000 of revenues, but no tax liability. That's going to happen in the future. And so we're going to have to pay taxes when we receive those payments in years 1, 2, and 3, if you remember the example. And so that's a deferred tax liability. A deferred tax asset is if we have an expense on the books, but we don't get a deduction that reduces taxable income until the future. Again, like a prepaid. And then actual income tax expense on the tax return. And we don't use the word plug very often in accounting, because a plug would not be normally verifiable. I would say what's going to be verifiable here is the deferred tax asset and liability. They're verifiable. We can support that, the differences between book basis and tax basis. And so tax expense is the plug that after we've corrected the DTA and DTL, that's the last step of recording the journal entry. We plug whatever debit needs to go into that journal entry after we've corrected the DTAs and details, and you'll see this. Okay, like my example, here is this company reported taxable income of 100 million. And there's a lot of stuff that's the same. So keep in mind, the 100 million on the taxable income on the tax return is the same as 100 of this 140. So a lot of the rules are the same. There's just some little pieces that are different. And for this example, there is one difference, and that is a $40 million installment sale. So, let's just assume the base income in all 3 years, except for this installment sale, was 100, 100, 100, 100. I'm looking at the book side now. But they had this $40 million installment sale that got reported on the book side, but not reported on the tax side. So that's a difference of 40 million. When the installment note or the notes receivable is collected, and we received 10 million in 2019 and another 30 million in 2020, that's when it hit the tax return. So notice in the first year, book income is higher than tax income. By the way, that's my first clue that I've got unless I have permanent differences, I've got a deferred tax liability, because book income is higher than taxable income. It means I've saved some taxes there that going to reverse for all the temporary differences in the future. And we see in this example, they do reverse. That 40 that we reported as income on the book side gets reported in the tax return in the future years. So what are we going to do? Now, this has got some more noise to it than my simple example I showed you. So we're doing 2018. And so we've got to start with the tax return. So step one, when you're working these problems, step one is what is the tax expense on the tax return? And by the way, we will not file a tax return until after year end. So we kind of estimate what that taxable income will be in the tax return. And we've got to record an income tax payable. That's step one. So this is all the 100 million, the same on both sides. It's in the tax return. So we go record an income tax payable of 40, step one. And this step one is true for all the deferred tax assets and liability probable work. This is always step one. Step two is go calculate what the desired ending balance is for deferred tax liabilities and deferred tax assets. Here we don't have a deferred tax asset, so we're just going to calculate the ending piece, and that becomes 40% times the difference. The difference is 40. So in other words, we know this difference of 40 is going to reverse in the future years. And at a tax rate, that 40 times 40% equals 16. So we know we started with zero beginning balance. Let's assume this is the first year of this company, or the first time they had a temporary difference, zero. So our deferred tax liability needs to be 16. It's zero. So we got to do what? We got to record a credit. Sometimes the desired ending balance will be less than the beginning balance. We could record a debit in this journal entry. What we're trying to do is we're going to go calculate the ending balance for deferred tax liabilities and deferred tax assets. And then we're going to go look at our balance in those accounts and see what journal entry we need. This is easy because it started with zero. And the whole amount becomes a deferred tax liability. This is now creating the deferred tax liability. So we credit, step two, the deferred tax liability. Also in step two, we need to take care of our deferred tax assets. There are none. And this problem, so we're easy. Step three, final step, calculate income tax expense. And this income tax expense is what will go on to the income statement. It's really, really important number. Dollar for dollar, it affects net income, right? Because we have income from continuing ops, and then tax expense, and then net income. So people are tracking this line item. Investors are tracking this line item closely. Now, how do we come up with income tax expense? As I said, plug. What debit do I need to make my debits and credits equal? I've got 40 plus 16, 56 is probably million, let's call it millions, in credits. So I need 56 million in income tax expense. There you go, debit. And that goes right to the income tax return. Fun stuff. Go to year two. And we can, we're going to do the same thing in year two. We had 100 million. Remember, the income tax payable. Okay, we start with the income tax payable. Let's go back to what that income tax. Here was the income tax return, 110 and 130. Because that 10 and that 30 show up there. So our in this year, our income tax payable is 110 million times 40%. Now we know at this point, and we would look at our notes receivable, which we'll see in a later step, that I only have 12 left of that reversing difference. So I need to be at 12. So I'm going to have to debit my deferred tax liability in this case. Look, I've calculated my ending balance. My beginning balance was 16. How do I take a credit of 16 to a credit of 12? I got to do a debit. Get back to your debits and credits and your logic there. So in the journal entry, I debit the deferred tax liability for 4, and then this number, whatever it takes, to plug to make my debits and credits equal. I have 44 million in credits, and I only have 40 million in debits. 44 minus 4, I need 40 to make 44 equal 44. There's my income tax expense in year 2. Year 3, everything's reversed out now. My ending balance for my deferred tax liability needs to be 0. I started with 12. But let's go through step 1. Step 1 is the income tax payable. 130 million right here. That's the amount going on our tax return times 40%, 52 million. Step 2, look at my deferred tax liability. I need to be at 0. I got a $12 million credit balance. How do I change a $12 million credit balance to a 0 ending balance? $12 million debit. It offsets that. So now I have a $12 million debit in my journal entry. Step 3, easy. My debits and credits have to be equal. That's why I love accounting. It's idiot proof, and so we just have a plug. What debit needs to go there to make 52 equal 12? 12 plus X equals 52. Simple algebra. 52 minus 12 equals 40. I got 52 on both sides, so my income tax expense is 40. And so we see what happened to the deferred tax liability. We started with 16 and reversed out 4 and 12 ends up in 0. Now, this is very, very simplistic. If you're in a company doing a lot of installment sales, they're all going to be at different times and going on. And so you can't track every single one of them. So we're going to look at it from how we can do it from the balance sheet side. So deferred tax assets and liabilities can be computed, kind of a shortcut method, from the temporary books tax differences. The book value of an asset or liability, original value, minus any amortization, impairment, or other things recognized for accounting purposes. And tax basis is its original value for tax purposes, reduced by the amounts included to date on tax returns. We'll look at some examples here, but let's think of, let's start with an easy one, property, plant, and equipment. So the book value of, let's say, a factory. Let's say we have a $100 million factory and we're doing 10 years straight line. So $10 million of expenses go through year 1. 100 million minus 10 million. The book value of that factory would be 90 million. Tax basis, we could take accelerated, maybe double, triple. Let's say the tax depreciation in year 1 was 20 million. And so what is the tax basis of that factory? 100 million minus 20, 80 million. So the book value is 90, the tax basis is 80. I can do something with that. I can think through that logically, and I know that $10 million difference is going to end up being a deferred tax liability because I booked, more expenses, got more deductions now on the tax return that are going to reverse in the future. Let's think about a second one, warranty. So let's talk about a warranty liability. So if I book expenses on estimated future claims, I create a warranty liability. Let's say we have $30 million sitting in our warranty liability account. Again, that represents all the expenses I've recorded in my books minus the claims. What's the tax basis of a warranty liability? They don't have a warranty liability, right? Because it's just cash basis. Whenever you pay it, we give you a tax deduction. So there's no liability for future claims on the tax basis. So the tax basis of a warranty liability is 0. Now I can look at that $30 million warranty liability versus 0, and I can calculate, I will know, hey, these are deductions I've taken on the book side that I'll get in the future when the claims come in. I just take my warranty liability times the tax rate. And what do I have? Deferred tax asset, because that's going to relate to future tax deductions. And we're going to walk through some examples of this, and hopefully you're following along with my words here. I know it's might be hard. I'm trying to go slower than I normally go. So here's some types of temporary differences. Like we saw the installment sales, unrealized gains from some investments. We record those unrealized gains as income on the tax side, but not on the book side. On the expense side, estimated expenses that are only deductible and paid. That would be like warranty. Sometimes salaries payable could be like that, or contingent liabilities, unrealized losses. And so here, revenues, here's another one. Rent collected in advance. When people give us, rent, that becomes a deferred revenue on the book side. We don't record anything. On the tax side, it hits a tax return. You have income on the tax return. If we collect money for subscriptions in advance, magazine subscription, you remember that's, for us on the book side, debit tax, we don't get credit revenue. It doesn't hit the income statement. We credit deferred revenue. Later, we'll recognize that revenue as we send out the magazines. But however, on the tax side, boom, once you got that cash, it's on the tax return, income. And so this would be where, in this case, in both of the blue cases, by the way, the taxable income is going to be higher than the book income. I mean, we're going to pay more taxes now. But guess what? These are temporary differences. They will reverse. So we'll pay less taxes later. I like to follow this logic. Taxable income is higher than books. Means I pay more taxes now, but I pay less later on a cash basis. Kind of sounds like a prepaid kind of asset, if you will. And that's what it is. It's a deferred tax asset. Now, in the purple colors here, and we didn't talk about this slide here, but we can have accelerated depreciation on the tax return, so greater expense on the tax return in the books, or prepaid expenses. That's like the opposite of this, rent collected in advance. When we pay for some, if we're on the other side of that magazine subscription and the company bought a magazine subscription, we're going to, again, that's going to be a prepaid. We're going to, credit cash, debit a prepaid expense, and we'll record the expense as we get that subscription. Not on the tax side, you get an immediate deduction. So on these purple ones, because we're recording expenses here earlier on the tax return, and we're recording gains, revenues later in the tax return. On these two purple ones, the book income is higher than the tax return. We've recorded greater expenses of depreciation on the tax return. So the tax return has a lower income, and we paid less taxes now. But keep in mind, temporarily have paid less. In the future, we'll pay more. These taxable amounts will come back to bite us. We'll pay them later. So when the taxable income is lower than the books, that means that's going to reverse around. I've got a deferred tax liability. So these purple ones revert, become DTLs, and these blue ones become DTAs. So I've talked about deferred tax assets. Here's a slide on it. And so those are recognized for future tax benefits, for future deductible amounts. Like the warranty. I'll be able to deduct that warranty expense in the future, but not now, because I'm just estimating the expenses. The IRS says, no, I don't believe your estimates. When you get the actual claims in, then you get a deduction. But that's going to be in the future. And so I'm going to save taxes in the future. But again, I want to get my tax expense right now on an accrual basis. So I'm going to credit defer. I'm going to credit income tax expense and debit my deferred tax asset. I'm going to reduce that. So future deductible amounts in recording the deferred tax asset will decrease, taxable income. So here is the warranty expense, and again, like the installment sale, the base income was 100 million in all years. So without this warranty expense, we'd have had 300s here, we'd have and 300s here. This is just like the problem I will head of this lecture. So bear with me, and hopefully, if you're still confused by that, hopefully this will help you. But this 100, we subtracted warranty expense. Remember, we debited warranty expense and credited a warranty liability. And so the book income was only 70, not 100, because we recorded warranty expense. And the tax authority said, no, you don't get that. We're going to just keep the 100 that you started with. We're not going to allow you to deduct that 30, because there's no, show me the claims that you paid. They don't, maybe trust the estimates that have been made. But in the future, the claims do get paid. So in the future, this is a very simplistic example, no more future warranty expenses. In the future, it's just pure 100, no warranty expense was recorded, 0, but the claims came in. Now, what happens when the claims come in on the book side? Remember, debit the warranty liability, credit cash. We debit expense up front, and later we just reduce the warranty liability as claims come in. Not so for the tax return. They don't record a warranty liability. Tax base is 0. But later, when the claims come in, they'll reduce and record tax expense. Reduce taxable income, So on the tax return, this 15 and 15 will come later. So in the very first year, book income is lower than taxable income. That tells me if all that difference is temporary, that 30, I'm going to get savings in the future because my book income is lower than my taxable income. That 30, I know is going to become savings in the future. I could record a deferred tax asset. In the future years, tax return is less than the books. So let's go look at the journal entries here, like we did before. All right. Step 1, still the same steps for deferred tax asset or deferred tax liability. What is on the tax return? What's a taxable income on the tax return? That was 100. I'm going to multiply that times the tax rate, 40%, and I'm going to say, I'm going to go record my income tax payable of 40. There you go. Step 2, get my deferred tax assets and deferred tax liabilities corrected. My final balance is corrected. Well, I know I've got these future $30 million of deductions times 40%. I should be at 12 million here. What's my balance? 0. Therefore, I've got to go book a debit to my deferred tax asset of 12. And I book that here. Step 3, exactly the same is for DTLs. I got to plug my income tax expense. What debit do I need to make my credits of 40 equal my debits? Well, 40 minus 12, 28. So now I've got 40 million of debits on one side, $40 million of credits on the other side. And guess what? I now have my income tax expense. This goes to the tax return. This deferred tax asset, that's going to be on the balance sheet as an asset. This 40 is going to be on the balance sheet as a liability. Step 2. All right. Remember, in year 2, my taxable income was 85, and also in year 3, 85. Because we got the $15 million deduction. So step 1, income tax payable, 85 million times 40% equals 34 million. Step 2, go get my DTAs right. And so I started with a $12 million beginning balance from last year. We just calculated that on the previous slide. And I need to end, because I only have 6 million left. I have another $15 million deduction next year. So I need to end with 6 there. So I have $12 million debit. I want to end with a $6 million debit. I got to do a credit to make that work. Deferred tax credit, asset credit. My ending balance in the balance sheet will be now $6 billion deferred tax asset. Income tax expense a plug. Got to make my debits equal my credits. 40 equals 40. So income tax expense is 40. Year 3, pretty much the same thing. Calculate my income tax liability for 85 times 40%, 34. And now I'm done with this temporary difference. My ending balance needs to be 0. I have $6 million debit, from the prior year. I'm going to credit that 6 and record a credit to the deferred tax asset, so I get to 0. Plug income tax expense, 40 equals 40. So we started with the $12 million balance. We credited 6, so we get to 0. Now, keep in mind, very, very simplistic. In the real world, we'll have new warranties every year, new warranty expense, new claims. It's moving all the time. And so what we could do, and what we will do, and this is what companies do, is just go look at the book basis versus the tax basis. And so the warranty liability on the book side is 30 million in that warranty liability. The tax basis is 0. So I got a temporary difference, a liability of 30 times 40%, 12 million. By the way, if you had a lot of warranty moving there, you just take whatever the warranty liability is times 40% and you calculate your deferred tax asset. Once you have your final, what you want in the deferred tax asset account, you do whatever debit and credit on your tax journal entry to get that right. Year 2, you got 15 times 40, you get it to 6, you get there was 0 liability in the books. That's very simplistic. Then 40 0. So you can see we can just go look in the warranty liability, look at the book value at any point in time, multiply times the tax rate, and we have our deferred tax asset for warranty. And you can do this for every balance sheet item. This is how companies do it. And the for Linux, where I worked, very complex because a global company, and the income tax entry was at the top, but it's a really big, like 3 or 4 inch binder full of stuff. And I'd review that. I'd get to that second sheet underneath the tax return, and I could see all the book tax differences and how that was calculated. And so this is the way to go. And they call this the balance sheet method, and appropriately so. All right, so that's kind of it for the first part. We're going to do some more cleanup here, going through the rest of this. The core of this chapter we've already covered, although I think this valuation allowance is really important. And so whenever you have an asset, every asset, we got to see, will we be able to realize this asset? And so for deferred tax assets, and I'm not getting into this whole example here, there may be some reasons that we'll never get those tax deductions. And maybe, pause here, you kind of think through, why wouldn't you get a future tax deduction? You should get it, right? Because it's going to reverse around and you'll get a tax deduction. What if you're losing money? If the company is losing money, this is the biggest reason for valuation allowances, I think. If the company is losing money, they can't take a tax deduction because they're not paying taxes. And so we've got to create a valuation allowance if it's more likely than not that some portion of a deferred tax asset will not be realized. And so we're going to, record a valuation allowance. A valuation allowance is a contra asset account. So it's a reduction of that deferred tax asset. And you have to look at every tax jurisdiction, separately to calculate this. And so for Linux, we had valuation allowances for some countries, around the world where we just weren't making money. and we had a whole bunch of, we had deferred tax assets related to those countries, but we had not made money in several years. It did look like we could make money in the future. So we had a valuation allowance in these. You could see on the footnote, the Lennox financial statements or other companies as well. By the way, valuation allowance, dollar for dollar impact on income tax expense. So if I end up needing more valuation allowance and I credit that, I'm gonna debit income tax expense. And it's always an estimate, so what if it goes the other way? I realize, wow, I don't need all that valuation allowance I thought I needed last year, and I debit the valuation allowance, then I would credit income tax expense. So dollar for dollar change in the income tax expense. You think that gets a lot of attention by the auditors in public companies and by people like me, chief accounting officer? Yes, that valuation allowance really, really matters. And it's judgmental. And so you want to make sure the tax department is using the right judgment around there, because there'll be some pressure to reduce at least the income tax expense on the financial statements. And this is one way to do that, is say, oh, our valuation allowance is too high, let's take it down. So so auditors are all over this. And a lot of the time at year-end close, a lot of the time is spent on, is the valuation allowance appropriate? And so here's that example where I said, hey, it reversed out in the next year. They didn't need the entire 3, and it became, they debited 2.5, and a credit to income tax expense was that? It means a reduction in income tax expense. A lot of disclosure required for taxes. Number one, you have to, and I love looking at these footnotes. It's kind of interesting, since, especially if you start understanding this. This is the Shoe Carnival company, and you can see they had in 2015 26 million in deferred tax assets, and they had a valuation allowance of $1,924,000, and they had no valuation allowance in 2014. So they had a, and this is in millions of dollars probably. Well, no, thousands of dollars probably. I bet, yeah, thousands. So they had $1.9 million hit increase in tax expense because of creating this valuation allowance from last year to this year. And here's their deferred tax liabilities. You look at depreciation, you see that a lot on deferred tax liabilities, meaning there was greater depreciation on the tax return through accelerated methods than on the book side. Therefore, those things will reverse out in the future. And so there's a deferred tax liability for that. Okay, next topic, permanent differences. They will never affect. There are transactions that will never be taxable or never be income. Or vice versa, there may be some tax-free income that will never be reported on the tax return. Interest received from investments in bonds by state mutual, there's some things that will never reverse. It's like, either good news, here, tax-free income that will never be reported, or bad news, some expenses that we'll never get benefit for. Well, in that case, the accounting is easy, you just ignore it. And because they don't reverse, there's not going to be future taxable amounts or future deductible amounts for these differences. Therefore, there will never be, I'll say this again and again and again, never, never, never be a deferred tax asset or deferred tax liability for permanent differences. So when you look at the difference between taxable income and book income, you really need to be clear whether those differences are related to permanent differences that create no DTAs or details, and temporary differences that do. Here are some examples of things that are permanent differences, and you could look at your textbook for that as well. So again, easy to account for permanent differences. They're calculated according to tax law, and since permanent differences are never taxable, again, I'll repeat myself, no deferred tax asset or liability is created. doesn't impact that journal entry. One last disclosure that I also enjoy looking at, you have to reconcile from the statutory rate, U.S. statutory rate if you're a U.S. company, to what your tax rate is. What is your tax rate? It's just going to be tax expense on your financial statements divided by your income before tax. So here is pretty interesting. How did you get to a lower effective tax rate? Our U.S. laws say 35%, but your taxable tax rate is only 30%. And you can see here, number one, an increase because state and local taxes, they had to pay that up top. And then a reduction because of foreign tax rates were lower. And Walmart must operate in quite a few foreign countries. And so you have to reconcile statutory rate that you think you should have to pay to what you actually expensed on your financial statements. So it's pretty interesting. Again, just some cleanup here, if you will, because the tax rate, remember, is a big part of the calculation of DTAs and DTLs. And what if we have a change in the law that reduces the tax rate or increases the tax rate? That happened, a couple of years ago under the Trump administration when Republicans were in charge, reduce the tax. Well, you cannot change the calculation of your DTA or DTL until it is a currently enacted tax rate in that year. And so imagine, could be a big change in your DTA or DTL based on a change in the tax rate. And so that could be a significant change in your income statement, in your calculation of income tax expense. And so again, that only happens when the tax rate passes. I just talked about that. You could have multiple differences. You will have multiple temporary differences in every geography that you operate. And so you have to look at them individually for each jurisdiction. And you are allowed to net them, deferred tax assets and liabilities, but only for each jurisdiction, not overall. Another change we had recently, and this is a great change, is that all DTLs and DTAs are considered non-current. I just applauded the FASB when they did this, because you used to have to go through all your DTAs and DTLs and decide when they're going to reverse. And if they're going to reverse in the next 12 months, the next year, I got to make those current. So that was like another just a crazy amount of work to go through every difference and see what's going to happen in the next year. And so they said, forget all that. Nobody cares whether it's current or long-term in this case for DTLs and DTAs. And so just put them all in non-current. And so that makes it easy. You can definitely get a multiple choice question on that, especially because I love that. Now, if they're in the same jurisdiction, as I said, DTAs and DTLs can be netted. So if the DTL is larger than the DTA, then I can just put a net deferred tax liability on my books. But it has to be jurisdiction by jurisdiction. Disclosure, companies must disclose all their DTLs, DTAs, and evaluation allowance. You really need to describe why did your evaluation allowance change. We talked about that. So with that, I hope that this was beneficial for you. Again, I would say because of all the pluses and minuses and in and out, tax rate, tax basis versus book basis, this can be intimidating. And I do think you have to spend some time on it. And then I will be going over doing some problems in the next lecture for this. And maybe that will be helpful to you. But again, get into the textbook, try to follow the logic, try to understand it. Think about that tax return, think about the financial statements and their differences. But I'd go back to that very beginning part of the lecture. Again, we're trying to match that tax expense or taxable income amount with the financial reporting time when that occurred. We're trying to match that. We're not cash basis. So this is nothing more than just accrual accounting. That's it. And with all of that lecture, what we're trying to do is take all of this noise and do accrual accounting for income tax expense. And with that, I thank you, my friends, for bearing with me in this difficult subject.